So we move into chapter 13, as you'll see, capital structure and finance costs. And certainly from my knowledge of the ACCA syllabus, this first area, which pertains to limited companies and their capital structure, is really the area that many sort of subjects spin off, rather than, let's say, the capital structure of a sole trader. So in essence, what I'm saying is limited liability companies, and in the form of their general structure, capital in equity or capital in debt, is an area that we need to get very familiar with, because you're going to see it quite a lot. So let's take a look at this first area, and this is just the diagram you'll recall, stripped out from the ACCA Study Hub, and a good diagram it is too. So we're assuming here a limited liability company, or indeed, if you will, an incorporated entity, and indeed the management of that entity, and indeed other players or other shareholders, if you will. There will be a myriad of stakeholders associated with a typical limited liability company outside of management and indeed shareholders. So, in terms of the sort of big picture, as it were, if we look at the left-hand side first, and we just focus in on the concept itself. Now, I've just touched on the idea of, a sole tradership. I could have talked even perhaps about a partnership. But really what we're saying here is that we incorporate, we sort of, in a way, sort of give birth to an entity. A business entity. And note that that business entity is an artificial legal person. In other words, it exists in its own right because you have incorporated it. Okay? Now, because the entity exists, and I know from perhaps your past studies, you'll know that this entity can do things. For example, it can sue, or indeed be sued. It can contract in its own name. And certainly, technically, it's not affected by a change in ownership, i.e., if shareholders can change every day, every week, every month, the business, in terms of its continuity, will still go on. It's a person in its own right. Outside of that, note that the shareholders are the ones with the limited liability, not the corporation. The reason that this is useful or advantageous is for people involved in setting up businesses, as long as you haven't done anything, for example, traded wrongfully or traded dishonestly or fraudulently, then technically, as an owner or indeed as a shareholder, your liability is limited to the amount of shares you have purchased. So, for example, if it's a multi-million-pound multinational company, if I've invested only $100 and I've done nothing wrong, something happens, a fraud or whatever, then my liability is simply the loss of that $100. That's it. But note, the corporation itself does not have limited liability as such. Okay? So that's really the concept size, and that gives certainly some advantages, but also some disadvantages, if you will. Now, outside of that, who manages this particular limited liability company? Well, the directors. And these directors are appointed generally by shareholders to manage the entity on their behalf. And when we say manage, what they should be pushing towards is shareholder wealth maximization. The directors, in the main, unless they are shareholders as well, don't own the company. They are employed to work in the company's best interests. Note, not in their own best interests. And these shareholders, as we see, they're certainly the owners. So really, the bottom line is that this separate legal entity, as long with its management, exists for the benefit of the owners. Okay? Now, in terms of this limited liability, I touched on it a few moments ago. Certainly the entity is liable to pay its total net assets up to its owner. So let's say it's liquidated, nothing's wrong. In effect, if it has a net asset differential, in other words, the excess of net assets or assets over liabilities of $10 million, then in effect that is owned by the shareholders, and that will be paid out, let's say, to 10 shareholders or one shareholder. Outside of that, certainly these shareholders, as I've mentioned, they are protected by this limited liability status. The amount paid in effect, what that means is the shareholding that they've taken. No, that could be $101 ordinary shares. Okay, so that's really the big picture in terms of more depth over and above what we saw in the early chapters as to this area of, well, how is the company financed and who's involved? More detail in a moment on that. So in terms of capital structure, clearly every business needs finances. In terms of forms of finance, well, a number of different possibilities. Ordinary shares, preference shares, or perhaps borrowings of some kind. Now, we're going to open up each of these areas in a moment. I'll take you through the diagram in just a second. Again, a good diagram. A lot of detail here. It's up to a business really to decide on forms of finance. A business may decide, well, when we've issued £1 million worth of £1 ordinary shares, we're going to go to the bank now to borrow 20 million. It's up to the business, the shareholders and the directors to decide the best route. Okay? Now, in terms of the best route, and indeed what the examiner is likely to play off in the exam, is really the sort of differences. So we see here, a broad heading, capital structure. So how a business might be structured in terms of its capital. We see left-hand side, shares, perhaps ordinary, perhaps preference, or a combination of both. We see on the right-hand side, debt, i.e., let's say, a bank borrowings, or possibly borrowings from a venture capital company. It's all debt at the end of the day. If we focus on the left-hand side of the diagram first, we see really two main streams or branches, if you will. Just ordinary shares first, and you'll see here a variety of sort of, if you will, qualities, associated with ordinary shares. These are the basic investment in a company. Certainly higher risk for reasons that we'll deal with in a moment. Generally higher reward. Certainly has voting rights at AGMs, indeed. Outside of that, normally a dividend, but there doesn't have to be a dividend associated with an ordinary share. This is up to the company to decide upon. And then outside of that, an ability to participate in surplus on liquidation. But again, more of that later. So for me, when I think of this basic area of finance, ordinary shares, some pluses for sure, but also some minuses, and those pluses and minuses will open up a little bit more as we go through this particular video. So there's one form, or an introduction to one form of financing. Outside of that, irredeemable preference shares. Now, don't be alarmed by the sort of term. This isn't overly complex at all. What we're talking about here is sort of a share that has a preference, as you probably guessed, slightly lower risk, lower reward, but some sort of return on it. Note, a fixed dividend. So really, if I was to go this route as a shareholder, I'd be doing it for several reasons. Number one, let's say I'm not overly interested in having voting rights on the direction of the company or the decisions that it makes each year at AGMs, but I would like some income, a fixed dividend. And notice the difference between fixed dividend here and varied dividend here. Varied meaning possibly next year, none, if that's what's decided upon by the company. Outside of that, we see that this particular type of share is classified as equity, and indeed note that it is irredeemable. Now, why do we say irredeemable? Because we'll see as we move to the right-hand side of the diagram that there is an option for a redeemable preference share. Okay, and what we mean by that is we'll see basically a share that in effect is not so much equity, there's more borrowings and can be bought back, or indeed will be bought back by the company. Okay, now just sticking with the left-hand side first, we're really dealing with the sort of lower-end forms, and we see as we get down to the payment of the finance due, Certainly, in terms of an ordinary share, and indeed most regular shares, we would have thought that share capital appreciation, in other words, a rise in value over time, is eminently possible. We hope, whether or not it's a private limited company or a publicly listed company, we hope that our investment in company A or company B or company C appreciates over time. Even if it doesn't, we're hoping for dividends. And certainly with irredeemable preference shares, we're absolutely guaranteed it based on the definition of irredeemable preference shares. Now, moving to the right-hand side of debt, remember that in terms of capital structure, broadly speaking, it's up to the company to decide how it finances itself. So here's some possibilities. Straightforward borrowing, sometimes referred to as loan notes. Don't be alarmed by the word there. We're just talking about going to the bank or going to a venture capitalist and saying, I'd like to borrow £1 million. So what's that? What does that entail? Well, certainly it entails, more than likely, particularly these days, security in some way. Some sort of charge, some sort of agreement fixed on assets of the business. And indeed, what we mean by that is, particularly when we're talking about large amounts, it's highly unlikely that borrowings, particularly significant borrowings, will be provided to any limited liability company without security, i.e. some sort of fixed and or floating charge on the assets of the business. And what that means, in effect, is if you default, you could lose those assets. Okay? So, on this left-hand side, we're really talking about, I guess, parameters. Now, one thing that it doesn't say in terms of the borrowings here, it talks about charges or a fixing on assets, either fixed or floating. But what you will also find in practice, in real life, is a requirement for directors or shareholders or other parties to provide personal guarantees in relation to company borrowings, and that can create issues, particularly where one person is agreeable and another person isn't. Perhaps one director wants to or can, another may not be able to or does not want to. Okay, so they call it in banking circles, or at least they used to call it, belt and braces, where bank managers, particularly the larger banks, yes, they want security, assets, etc., but they also want personal guarantees from directors, which means that potentially your house is on the line. If we move to the right-hand side, as mentioned, redeemable preference shares. Now again, this does what it says in the tin, similar to what we saw in terms of irredeemable, but note these are liabilities, and in effect repayable. So a slightly different kettle of fish, as it were, because albeit, yes, lower risk, fixed dividends, these amounts borrowed or these amounts invested in these redeemable preference shares will be returned at a given date. It's not up in the air. So again, pluses and minuses. Outside of that, when we look down below, we see that in the form of return or the payment of finance, as you'd expect, interest on borrowings, whether or not that's to VC or indeed banks, and certainly dividends, because these dividends, these fixed dividends, will be denoted in terms of a fixed rate, let's say a 5% fixed preference dividend. So this diagram is certainly very, very useful to you. Would I suggest that you memorize it right just now? No, get a feel for it broadly. Get a feel for the two different sides, and indeed perhaps the four main areas, encompassing the whole shebangsy. Let's move from there now in terms of what might happen down the line, given what we said up top on the different forms, if a company winds up. In other words, it just goes out of business, stops trading. What would happen depending upon what sort of finance perhaps you'd provided, whether or not it's ordinary shares or a loan of some kind as a VC expert, or indeed irredeemable preference share, etc., etc. Now again, this is quite important and quite a lot of information here. You'll see that different areas rank in different ways, and you'll see that unfortunately for ordinary shareholders, they rank right down at the bottom If you imagine, here's the sort of stop trading sign, yeah? And in terms of where we go with the assets, well, we've got to pay off the secured creditors first. For example, the bank, yeah? Outside of that, anyone else who is a secured creditor, e.g., the tax authorities, always secured. They get their money first. Next area is unsecured creditors. Now that would be typically trade payables or possibly an auditor. Next area is the preference shares on both sides. And then last one, and least unfortunately, is any residue. Now, depending upon the circumstances as to whether or not the ordinary shares actually get something, but often when a company stops trading or goes out of business, often things are perhaps not so good. So you end up in a position perhaps as an ordinary shareholder or possibly even a preference shareholder, really ending up with nothing after investing 10,000, 100,000, possibly more. So you can see, as we said, in terms of pros and cons up top, you can see clearly here that in terms of the shareholdings, both preference and in particular ordinary, there's some big downsides. But then, we have the protection and we have limited liability status, etc., etc. So in one sense, taking out with one hand and giving with another. Okay? Let's move from there in terms of more detail on the sort of sources of capital. So first things first, we've talked a reasonable amount about ordinary shares. So generally the most common form of capital that a company would issue. And indeed, as we saw, classified as equity. Typically, if someone says, well, I have shares in XYZ company, typically they'll be ordinary shares. Okay? Now, from there, key features is certainly a right to profits, note obviously subject to the decision of the company, a right to vote, important for some people, perhaps not for others, and, as we've said, a share of assets and entity winding up, but right down at the bottom. In terms of the accounting entry for the issue, it's fairly straightforward if you think about it. What we're doing here is raising finance, okay? So I issue, or I decide that I will issue ordinary shares in my well-established limited company. What happens? Well, the shares are taken up. In other words, in effect, I receive cash into my bank account. Bank is increased because 50,000 people, let's say, have bought one ordinary share each. What's the flip side or the credit side now that I know that I've increased my asset? Well, I credit capital, don't I, to increase it. Now, ordinary share capital, which clearly is an equity account, would be increased by, note, the par value. Now, all we're talking about when we say par value, and we'll see terminology on the other side of this mind map, we're simply saying that if a business has a share capital of $1 ordinary shares, then the par value is $1. That's it. So in effect, what I'm saying is, well, I've increased bank. I'm going to increase whatever the value by par is of ordinary share capital, the equity account. What about this share premium? Well, note that this is the element of the issue price exceeding the par value. So just because a share has a par value of $1, that does not mean that I have to issue it at $1. I could issue it to raise more finance at $1.20. On that basis, any excess over and above the basic par value is taken to what we call the share premium account, which again, as you'd expect, is in equity. And that's just simply the amount over and above par value. So the accounting entry really for ordinary share issue, pretty straightforward, I hope you agree, and follows our double entry rule. What about preference shares? Again, nothing overly complex here. Less common, yes, than ordinary shares. And indeed, some pluses and minuses in one sense. Certainly the idea of the fixed dividend is attractive, particularly if income is what you're looking for. But note, no voting rights. So certainly right to profit, that should actually say no right to vote. And certainly a share of assets in winding up. My apologies, I will adjust that once the mind map goes up. Now, remember that in terms of the winding up, we meant company goes bust, stops trading. Remember that preference shares just one step up from ordinary shares, okay? Now, in terms of redeemable preference shares, you'll remember that in the diagram we saw two different types. Now, redeemable, let's be careful on this because this will be tested, I think. In effect, these will be repurchased, i.e. to be redeemed. Now, this is an obligation. It's not like the company can down the line suggest, well, actually, we don't have the cash or we're not going to repurchase them. This is an obligation. They will be repurchased. Therefore, that is a fixed liability. That's a liability with a given or set date. Okay? Very important because I've seen this several times within questions where students get the classification wrong because it's a preference share. They automatically think, well, it must go to equity. It doesn't. It goes to liabilities. Now, in terms of irredeemable preference shares, note equity, of course, because they'll never, ever be repurchased. Just be careful on the difference there and indeed the logic behind it. So in terms of the double entry, again, I think this is fairly straightforward. Note, given what we said up top, if they are redeemable preference shares and I issue them, let's say, to the public, certainly debit bank, increase bank, debit assets and expenses to increase. In terms of redeemable preference shares, note liability will be repurchased in the future, therefore an obligation, not equity. Okay? The flip side, as we would expect, irredeemable. Same thing, bank increases debit assets and expenses to increase assets. Irredeemable preference shares, note equity. Irredeemable preference shares have increased. They're certainly not going to be decreasing by being repurchased by the company. That's above. Okay? Let's move on to our next area here, borrowings, or indeed, if you will, loan notes. So obviously, as mentioned, it's up to the company to decide how they finance themselves. And many companies will take on debt. There's nothing wrong with taking on debt. I mean, some observers would suggest that the more debt a company takes on, or the more debt you see on a statement of financial position, the more risky a company is. And that would be true because we know that debt comes with commitments. Now, a fixed rate of interest payable each year could be each quarter, could be monthly. Certainly the principal amount to be redeemed or indeed paid back at some fixed date. A loan doesn't last forever. Note also, and this is a big downside, if a company defaults, and I've seen this happen, then lenders clearly have the ability to sue the company and to do much more than that, to take the company down. One area that's relevant there is security. As we've mentioned, in other words, security on the assets of the business through perhaps a fixed or a floating charge. So again, pros and cons here from both sides. In terms of the accounting, again, pretty straightforward, really. I go to the bank, I'm running a large limited liability company, the bank gives me $10 million. What do? Debit asset with the finance, so increase the asset, but also, of course, increase my liability. I've just borrowed $10 million. That has created a liability. How do I increase the liability? I credit the liability. Not too complex. Now, this particular diagram, I'm going to leave this for you to run through, but I do, again, as I've mentioned elsewhere, I do think the diagrams in the hub are good. Let me just get this in the right spot for you. You'll see that this is really a summary of the sources of finance, and this would be a good starting point, certainly for revision, very quick to run through if we had this printed off, or obviously it's on the hub if you have it on your device or tablet, etc. So again, I won't go through it. It summarizes really everything that we've been through so far, okay, and very useful. Let's move on from there towards share capital, broadly speaking. Now, we've talked about ordinary shares, talked about preference shares. Now, with ordinary shares, a couple of options for us, note. We could go down the rights issue route. Now, what exactly does that mean? Well, we're talking about really a captive audience here. We're really saying that, okay, I want to issue some shares, but I have 10,000 shareholders already. What if I sort of cut my workload down and do what's called a rights issue, which is an issue of new shares to existing shareholders at a price below market value? Now think about it. This could be quite attractive because, as we say, we've got a captive audience. They are existing shareholders. Perhaps they've been shareholders with us for some time. Maybe it's quite simple, maybe a lot quicker than perhaps issuing shares to the public. Okay? Now note that a rights issue doesn't have to be taken up. So you could be an existing shareholder, say, well, actually, I don't actually want to buy shares at this moment in time. And that would give the option to the next shareholder, or indeed, in due course, possibly to the public. But in essence, in terms of the basic definition, we're simply talking about an issue to existing shareholders. Okay? Now, in terms of the accounting, quite straightforward alongside the double entry that we saw for a simple ordinary issue. So, debit bank, i.e. increase the amount in the bank, increase the asset. Credit ordinary share capital, i.e. the ordinary share capital must have been increased in some way, shape or form by the par value. And as we saw before, credit the share premium, or indeed the capital or equity account, any excess over and above the par value. Now, in terms of the advantages, we haven't sort of been through the full detail on how we would do a rights issue, but for our purposes within FA, let's just take it, let's simplify it. Let's say that we have 10 shareholders, and each shareholder has 5 shares each. Okay? The way that a rights issue would work is to suggest to shareholders, well, we're going to raise finance and we're going to do a 1-for-5 issue. In other words, for every 5 existing shares that you have, we're going to allow you to purchase 1 more at this price. So that's how a rights issue would work. Remember, it's based on existing shareholders, so you have to relate it to the number of shares that the existing shareholder actually has. So clearly, based on what we've said so far, it's more likely to raise funds and probably more quickly, because this is a captive audience, you have the details, you don't have to advertise, etc., etc. Certainly cheaper to administer, generally speaking, than ordinary issues. I'm talking about issues to shareholders, new shareholders, i.e. Joe Public, because these people are known, you have their details, etc. Now note that on the basis that all the existing shareholders take up their rights, so you've decided to try to raise $5 million. If all your existing shareholders take up their options or take up their rights, then no control issues are relevant, because they will all have, in effect, pro rata, the same number of shares. So the control is not affected in any way on the basis that they all buy in. Okay? Now, in terms of disadvantages, certainly, bank loans can be a cheap form of finance, generally associated with some sort of percentage fee based on the amount. But broadly speaking, certainly bank loans would be likely to be cheaper than doing a rights issue. There will still be legalities, regulations to comply with in relation to any issue of shares, whether it's a rights issue or not. In addition to that, point number 2, important, the market value is likely to fall of shares because, in effect, generally speaking, the rights would be issued a share price at below market value, and you've got more shares in issue. Indeed, outside of that, note, as I've said up top, if certain shareholders decide not to take up their rights, then the balance of control will change, and that may make a few people unhappy. Or you may have some disgruntled shareholders, perhaps those not taking up their rights for whatever reason, cash flow or just their preference. So that can be an issue. So pluses and minuses on both sides. Let's move on to a bonus issue. Now this is similar, but in effect a bonus issue is unusual in the sense that, a bonus issue is not for the consideration of cash. In other words, it's not to raise finance. It's more of a restructuring. It's where a company wants to restructure its equity, but again, it's to existing shareholders. So, if you think about it, it's a way when we think about the bottom of the statement of financial position, and we have a variety of different reserve accounts, and we'll see just in a moment how it works. We're really saying we're looking to slightly adjust reserves. The reason that we might do that is slightly outside of the FA syllabus, but just take it at this stage that a bonus issue is a bit like saying with a rights issue, well, you have 5 shares, we're going to give you a bonus issue of 1 for 5, but we don't need any cash. So note that the overall capital in the company, strictly speaking, stays the same because there's no new resources or no new cash. This is more of a accounting restructuring, sometimes referred to, as you'll see here, as a capitalization issue. In other words, an issue that sort of relates to the capitalization of the company or how the company looks to be capitalized. In terms of the double entry, quite straightforward really in one sense, noting that obviously bank and cash aren't relevant here. Now, this being a restructuring does involve the ordinary share capital, i.e. equity, because technically we are issuing more shares. We just happen to be issuing them for no cash or no consideration. So we must debit somewhere. So where do we debit? Well, we debit to other related reserves. For example, share premium or retained earnings. Now you may think, well, that's a bit vague, but really in one sense, the answer is we need to debit somewhere, and it has to be within reserves if we're looking to increase the value of ordinary share capitals. And these are really the only 2 options. It's either the share premium or the retained earnings account. Okay? Now, in terms of the advantages, I've said, well, it would be like a 1 for 5. Oh, John Smith, you have 5 shares. We're recapitalizing or restructuring our equity section. We'll give you 1 for 5. And generally no reason why individuals would not take up the offer of a free share. So in terms of advantages, it certainly increases the number of shares that a company has. It means that the market value for share could make the shares more marketable. There's more shares in issue. Note, okay? Increases the share capital balance. Now, you may say, but it was simply a restructuring. Well, people read accounts in different ways. It may well be that it works for this particular company to look as if they have more shares in issue. Outside of that, certainly from the perspective of the shareholders, they're really getting something for nothing, aren't they? They're getting 1 more share, albeit for the fact there may not be any massive increment in the value. They certainly have 1 extra share. Outside of that, no dilution of ownership, because everybody, for sure, is going to take up the bonus offer. Nobody's going to refuse something free. These shares are free, being made for several different reasons, or perhaps 1 reason. So certainly, absolutely no change in control. What about disadvantages? Well, again, as with everything, there is cost. Cost is relevant in any issuance of shares. Now, note that in terms of the option for either the share premium account, the debit, or the retained earnings accounts, note that if we don't have a share premium account, then we have to use retained earnings for the debit above. Okay, you remember we have 2 options, and that, broadly speaking, will reduce potential dividend amounts going forward. Remember that dividends are paid from retained earnings. And the obvious one, obviously, it doesn't raise any cash, but we're not doing it to raise cash as such. So that's really a moot point. We're doing it for other reasons. So in terms of terminology, we've dealt with quite a lot of new terminology already within this particular video. The par value we touched on, sort of the face value, if you will, maybe the legal value. Shares might have a par value. I think I used the example of $1 ordinary shares, but it could be 50 cents, it could be 10 cents. Now, just here, a word of caution, be careful in questions that pertain to shares as to what the par value is, because the examiner can and does play tricks on this area. So, for example, if the examiner was to say that the issued share capital paid up, fully paid up, was $100,000, and that the par value of the shares was 50 cents, we know that there is not 100,000 shares in issue. We know that there's twice that, because the share par value is 50 cents, not $1. And that, if it makes sense to you, is the trick that will be played. So all I'm saying is that may lose some translation right just now, because we're just getting up on the horse, just getting better at this whole area of capital, shares, etc., etc. But just be careful on questions where the par value is in play and where it's not a whole amount like $1. Okay. Next area for us is slightly different, the authorized share capital. So again, related to when we incorporate, when we set up a company, certainly we establish the par value, obviously, of each share, and indeed the maximum number of shares. So the authorized share capital is just a function of that. So it could be that we incorporate, that we agree on the maximum number of shares being 1 million and the par value being $1. So therefore, one times the other gives you the authorized share capital. In terms of issued, slightly different, sometimes referred to as, the allotted share capital. So in essence, just because you have an authorized share capital, for argument's sake, of 1 million, doesn't mean that you've issued them all. You may have just issued 100,000. So the issued share capital is really what has been, in effect, issued to individual shareholders, which is not necessarily the full authorized. Think of authorized as capacity, as it were. Now, what about called up share capital? Now, note that a company may not necessarily sell this issued share capital at the par value. It's up to them. The amount issued or called up to shares is maybe a percentage. So they could be a par value of $1, and they could be issued or called up at 90% of that, 90 cents. Outside of that, called up, paid up, slightly different again. So where we're calling up, let's say 90%, some individual shares could take time to pay. So, the paid up is the amount actually paid. The unpaid amount is the amount still to come. So much of these definitions, you'll agree, I hope, are fairly sort of commonsensical. Okay? So, in terms of our next section, cost of capital, we've talked about different forms, borrowings, ordinary shares. We've talked about preference shares, irredeemable versus redeemable. What about the whole area of how much it costs us? Now, this is an important area for your ACCA studies generally, because cost of capital is a big examinable topic in many, many different papers. So what we mean is, what does it actually cost us to have this capital? Oh, we've got 20 million in ordinary shares, 5 million preference, got dividends due on those, and we've got some borrowings from the bank. We're interested to know, basically on average, what is our cost of capital? That's a useful number to have, because, for example, we can gauge future investments based on estimated costs of capital for those investments. So at the end of the day, we're talking about costs. One cost, clearly, with shares, is certainly going to be dividends. So really what we're talking about with dividends, as you'd appreciate, is some sort of distribution. If you've got shares with us, we've issued a dividend, you're going to get a dividend this year. Now remember, the difference between Ordinary shares, where the dividend can vary and it's up to the company to decide. And indeed, preference shares, which generally come with a fixed, guaranteed, absolutely guaranteed dividend, let's say 5%, 6%, 4%, or whatever. Now, note that these dividends are generally proposed by management or a C-suite board and approved at general meeting. Now, in terms of the dividends on ordinary shares, note, as we said, that if you have ordinary shares, you're not entitled to anything necessarily, okay? But generally speaking, individuals invest in companies to get a return, not just capital appreciation. They generally want dividends. And if a company has a track record of dividends over the last 5-10 years, then generally speaking, shareholders would probably expect that to continue. Now, in terms of possible methods, and we're talking about the directors and indeed the FT, etc., it might well be that it's a percentage of profits. It could be a percentage of the par value, or perhaps even a dividend per share. Again, it's up to the preference of the company itself. There's no hard and fast rule as to how you should calculate your dividend payments. Now, in terms of the accounting entries, let me just go back here. Pretty simple. For dividend on ordinary shares, we're simply talking about, debiting the P&L account, in effect, and crediting bank. Now, I'm paying, as a company, dividends out to a shareholder. Therefore, my asset of bank must be reducing because cash is leaving my bank account. Where do I debit? Well, I must debit retained earnings because that's where profit is housed. If there's nothing in retained earnings, then strictly speaking, I can't pay out a dividend from profits because there is none. Okay? So the logic there is fairly straightforward. What about on irredeemable preference shares? Excuse me. As you'll see here, logic basically the same. We're talking about reducing the bank for the amount of the payment and indeed taking the money from retained earnings because that's where profits are housed. So simple enough, I hope you'll agree. In terms of finance costs, now note that we saw on the other side of the page that finance costs really are costs that the company incurs in relation to debt of some kind, obligations, a bank loan, VC, etc., etc. So in terms of borrowings, any form of borrowings, but also note, as we saw, redeemable preference shares, because they're classified as a liability, not as equity. Okay, so finance costs, broadly speaking, interest as per the above. Now, in terms of these dividends, as you'd expect, as I've just said, I would call them dividends. You might call them interest costs because they are at a fixed cost. Interest on borrowings, finance cost. The accounting entries, as you'll see here, are again quite straightforward. Credit side, credit the bank, i.e. reduce the asset. This money has left the bank account. It has depleted my asset. I must credit. Finance costs are an expense, absolutely. What do I do to increase an expense? I must debit the expense, thereby increasing or indeed reducing profits. Okay? So, a fair few double entry areas to fix on. Don't try to get them all at once. Do one by one will help us. Note that they tend to work in similar ways. Last area first is this statement of changes in equity. Now, we know that this statement in effect is really part of the equity component. And what exactly do we mean? Well, we sort of mean the total capital and reserves. And we know that total capital and reserves has to be the difference between total assets and total liabilities. So, in essence, what we're saying is this really houses what's sort of due to shareholders in terms of equity interest. Okay? Now, In terms of other key points outside of definition, let me just move this across so that you can see what we're doing. Certainly, reserves come in many different forms. We've seen just in this particular video, we've seen share capital, we've seen preference share capital, we've seen share premium, etc., etc. We've also seen in other chapters over there is, of course, revaluation surplus. So, strictly speaking, reserves, they're used for a specific purpose. They do not represent reserves of cash. So don't think of them like a bank account. Outside of that, technically, they're not provisions as such. In other words, they're not strictly liabilities that we create for one reason or another, like an accrual. Not at all. Now, outside of that, note the difference between a distributable reserve and indeed a non-distributable reserve. We've said that we know the definition, but note that some, may be distributable, some may not be distributable. So let's take this a little bit further. When we think about, let's say, a dividend, for example, we saw that dividends may be paid to ordinary shareholders. Note that, we need distributable reserves to be able to pay a dividend to ordinary shareholders from retained earnings. If there isn't any there, then we have an issue. Okay? Flip side of that, what about something that is non-distributable? Well, a share premium account is non-distributable. You can't simply just use a share premium account willy-nilly, or in any way that you want for any purpose. Now this, in terms of the detail here, don't be overly concerned. This is quite in-depth and quite high level for this FA course. It's included, obviously it's relevant, but it is a little bit sort of high level, I would suggest. In terms of the share premium, certainly the share premium, as we've just said, it's not strictly available for distribution. It has limited uses. Certainly, as we saw up top, bonus issues, we saw we need a debit against the credit to ordinary shares. Possibly settling ordinary expenses or premium expenses on company formation, or possibly paying a premium to redeem shares or borrowings. Outside of that, in terms of revaluation surplus, so we know what a revaluation surplus is. In essence, we're simply talking about the idea that we really revalue an asset, as we saw from the earlier chapter, and indeed we put this balance, let's say on land and buildings, into the credit of the revaluation surplus. Okay. Now, note it cannot be used for dividend payments. Note that it's non-distributable for that purpose until the actual surplus is realized from the sale of the asset. Okay. It can certainly be used in relation to bonus issues that are deemed to be paid in full, as we saw up top on this side of the mind map. Okay. Now, in terms of retained earnings, we know retained earnings are just basically the dump account that after everything is done and dusted, profits go into, accumulated profits. And certainly, it's a key part. One area that I'd be looking at for any business, if I was asked to analyze it, is, well, what do the retained earnings look like? Because that's a show of sort of force, accumulated force, as it were, over a long period of time. It's, the reinvestment in operations of the business, the profit retained, okay? And certainly, later dividends can be paid out. Certainly, we can use, on occasion, portions of retained earnings to transfer to other named reserves. And indeed, in terms of the revaluation, we saw within the revaluation chapter PP and E that where we're revising, or indeed where we're sort of realizing even a revalued asset, in other words, the gains on it, we need to ensure that we allocate and indeed charge to the right place. So, for example, if you look at the last sentence here, you'll see that when a revalued asset is sold, retained earnings will effectively include the same profit on disposal as if the asset had not been revalued. Okay. Now, again, a little bit more detail, I think, than an FA student would need. This is, or the likelihood of questions, let's say on this particular point, or one or two that I've mentioned up top, slimish, still possible, but not 4, 5, or 6. I think the questions in the exam, and you'll see from a cursory look of past exams, are very much based around double entries and definitions for reasonably straightforward areas and reasonably straightforward transactions. Now, in terms of this statement of changes and acts, we've touched on this. Really, we know that this statement is really a reconciliation. We're looking at the opening balances and really the movements in various equity accounts over the course of time, whether or not that's share capital. Oh, did we issue shares? Yes, we did. Well, there's the issue there. Did we issue shares at a premium? Well, yes, there was a 20 cents premium per share. Well, we can see the share premium amount moved. Revaluation surplus. Did we revalue land and buildings in the year? Yeah, we did. Well, we can see there's a movement on the revaluation surplus reserve. Retained earnings. Did we pay a dividend in the year? Yes, we did. Well, you can see the entry in the movement on retained earnings. Okay? So, in terms of closure on this particular chapter, quite a substantial chapter for us, and one or two tricky areas I think that will be examined, maybe one or two tricky areas that are less likely to be examined, as I've highlighted. My advice certainly is do review the double entries. Okay, the double entries in this chapter are a little bit trickier, I would say, than perhaps in one or two other chapters, for example, receivables and payables, or possibly depreciation, because they're sort of standalone. I think the double entry in PP&E on depreciation, etc., tends to follow a pattern. These double entries are sort of, in one sense, unique in one way or another. So be careful with that. And indeed, as I always say, practice on OT questions is absolutely our key next step. Okay, thanks for listening. I hope that your studies are going well.